Hello, everyone. Welcome to another episode of Trader Talks. In this episode, we're going to focus on how to find a trading edge. This is a great episode for newer traders, for experienced traders, and also investors as well, who are maybe struggling a little bit to find that consistency. We're going to go over a few different bits. We're going to explore exactly what even is a trading edge, how it can help us as well. We'll explore some of the problems that people have, especially at the beginning of their trading careers. We'll also, as mentioned, define what trading edge is and talk about how consistently profitable traders and investors use that going forward in their trading journey. The trader's problem, then, well, let's first of all ask a very simple question. Why do we trade? It's to make money. The simple reason, the number one reason people trade to make money. Now, ideally, over time, what we want to see is a steadily rising equity curve with very limited drawdowns along the way. We're going to lose trades. Of course we are. If anyone says they win 100% of their trades, run a mile, because they're lying. We are going to lose some. We just want those losses to be minimal, and over time, our equity curve to be pushing to the upside. However, as many of us will know, a small percentage of traders achieve this. Now, why is that? And we'll discuss that very shortly. The point I want to make is we've got to understand to lose, or how to lose, before we can even think about winning. Now, if we talk about some of those problems that traders have, the majority are just going to lose money over time. Their account balance, let's just say, starts at 10,000 and they sort of just month on month are losing 9,000 and 8,000 and 7,000. Just over time, just the drawdown just happens steadily. And most people, as we know, do lose money over time. You've heard the stats, 90% of traders lose 90% of their account within 90 days. This is a steady decline. And they don't have a structure. They don't have a strategy that they use. They're risking too much. They're trading at the wrong time. They're trading too many products. We all know the reasons why people can struggle. And that's really what leads to that consistent drop of the account balance over time. Now, another category of people or traders that fail is the boom and bust traders. We all know someone, or we are that person, that has had an account balance where they've traded and they've got really big winners because they're risking too much, because they're holding the trade over the wrong period of time and get a bit of luck. But usually what then follows after that is a bigger loss. Then they'll have another big win because they risk too much. They chase it, they revenge trade, and then they have another big loss as well. They keep moving their stop loss, or they don't even have a stop loss. Now, I'm at the moment mentoring a good friend of mine, and his issue at the moment is his losses outweigh his winners. He can't accept when he's wrong. This is what we really want to drill down in this lesson and for future, is start with your stop loss. Decide, if this trade doesn't work, I am wrong here. I am willing to risk this amount. And we'll talk about risk reward and win percentage shortly. But if you're going to take anything from this lesson, let it be control those losses, understand how to lose. And when setting your trade up, it can be very beneficial to start actually with your stop loss, deciding where you're wrong before the trade has even started. It actually can help a lot psychologically with that. Now, what is an edge? This is why you're continuing to watch or listen to this. And just on that, remember, if you are listening on the podcast, there's a link below where you can follow on YouTube as well. There's a couple of slides that might help as well, just graphically to show you what's going on. But we're going to use the casino principle here when talking about an edge. And I'm sure many of you have heard of a casino or even been to one. And many of you therefore would have heard of roulette. So to keep it simple, there's 36 numbers, 18 are odd, 18 are even. So when the punters, when the gamblers bet on either red or black, which are the odd and even numbers, winning should be 50%, right? However, as many people will be shouting out loud, the casino has a 0 and a 00 green, which skew the stats in the favor of the casino. So therefore, the casino would win 53% of the time, and the players would win 47% of the time. That is an edge for the casino when people bet on red or black. It's skewed in the favor of the casino. Now, let's just have a look at 1,000 bets. 1,000 bets on red or black that happen each day at this casino. Okay, so the casino is going to win 530 of those. So that means they make 5,300 if those wagers are $10. And for this example, they are. The gamblers would win 470 of those bets. So the casino knows that of that, it has lost 470 times of those $10 wagers. But that means the gamblers make 4,700. Okay. What is the casino P&L of that? It's plus 600. Now, that might not sound like a massive total, but this is when scalability comes in. And this is when us as traders, we need to have a long-term view. We need to have a realistic outlook and understand that our strategy, while each trade may not make us loads and loads of money, over time, it's going to compound, it's going to grow. So let's use the casino example. How many casinos are there? Let's say I own the casino and I've got 5, 6, 7 in the UK, 10 in Europe, however many in America, which would obviously be amazing for me. I wouldn't be sitting here talking about this, but you get the picture. You know, how many players? It's way more than 1,000 bets a day, isn't it? You know, how many wagers per table, per day, per week? And this is when you think about how many trades you take a day, a week. What does that look like over a year? We got to understand how we can use this principle for our own trading. So if I have an edge, I'm just going to focus on that. Maybe in just one market, I'm going to get a sample size. I'm going to work on developing that edge and realize that over time, over a week, over a month, over a quarter, over a year, this is when you start to see that those numbers can really start to pick up. Now, of course, we've got to talk about risk reward, and that will come shortly. But before we get to that, let's just talk a little bit about the psychology of things. We now know how to define our edge, but for the trade idea that we have to work, we need other traders to also buy or sell in the same direction that we want our trade idea to go. However, and this is very important, it is impossible to know whether other traders are even going to turn up this time. Statistically, we can know that our trade idea is more likely to win our edge, but we can never be 100% sure. It is completely impossible to know the exact distribution of our winners and losers and when they're going to happen. So this is really important for us to learn. If we see our edge, let's back ourselves. Let's back our stats. Let's just say my edge, and I'm going to make one up here, is whenever a stock goes above a 200-day moving average on the daily chart, I'm going to buy with a 2-to-1 risk reward if it's a certain time of the day. Okay, that's my edge. If I see it, I'm going to take it because it might be my stats show me you're going to win 60% of the time. Now, I don't know which 60% of the time it's going to win, but I've got to take it. If it meets my criteria, I've got to take that. Executing a trading edge is similar, and I use this example a lot, is similar to flipping a weighted coin. So here in the UK, for those that are listening, you've got heads or tails on a coin, and you see, you know, before a football game or an NFL game, whatever it might be, the referee will flip a coin in the air and say heads or tails. Now, let's pretend we've got a weighted coin. Okay, and of that, 60% of the time, it's going to flip and land on heads. That's an edge. Okay, we've got an edge that we know 60% of the time we're going to win. However, we don't know when. We don't know when we're going to lose. Okay, so we got to still, you know, flip it in the air because we know 60% of the time we're going to win, but we also know 40% we're going to lose. We just don't know which flip that's going to happen. And that's why it's important as traders, we understand we are going to lose, but we can't let those losses get out of hand. I was speaking just recently with our editor-in-chief, Mathieu Lon, And we were saying his background is very much fundamental analysis, value investing. Mine is a mix of technical analysis, trading, medium term sort of swing trading. Very different approaches. But what's helped us be consistent over the long term, and his is definitely way more longer term than I am, is risk management. It's controlling risk. That is what trading successfully is all about. Now, the maths, let's talk about that. So while the casino and the weighted coin, they use win percentage as their edge, in trading, it is different. Okay, so we could win 70% of the time but still lose money. And you've probably all been through that or know someone that wins more trades than they lose, but lose money. And I was there at the beginning. I just would, I'd win probably 70% of the time, which is great, by the way, but my losses would be very small. I'd come out too early. But when I was losing, I'd be happy for it to hit my stop loss or sometimes even move my stop loss. Okay. So a successful trading edge, it manipulates the amount of time spent in the trade. You know, that what I mean by that is until the profit target is reached. And that could be 5 minutes, it could be 4 days, or it could be months. Okay. Risk reward ratio is very key. So just to keep it very simple, the higher the average risk reward of a trade, the lower the win rate could be for us to still make money. So example, let's say per trade we risk $100 or £100 or €100, and we look to make $200, euros or pounds. That's a 2-to-1 risk reward. Okay. Now we only therefore require a win rate of 33% to be above break even. So above 33%. Okay. Now for a newer trader, sometimes that can be psychologically a bit easier. To win more than 50% of trades is hard. But if you win 50% of your trades where you're risking 100 to make 200, you're going to be very, very nicely in profit. And again, think about how that compounds over time, over the weeks, months, quarters, and years, and so on. Now, onto the profit expectancy curve. And for those watching on YouTube, there's a little bit of a diagram, but I'll also be able to explain it. It's very important for us to understand risk reward and also know where our break-even rate is. So, you know, as the risk reward goes lower, the win rate has to go higher. Now, I've worked with traders where their win rate is 70%, but it has to be that high because they risk more than they look to make. But they're consistent in that approach that as long as they get 70% of their wins, they're going to make money. And I've also worked with some traders where they only win 1 in 9 trades, but because their risk reward is so high, it means they're going to be okay. So there is no secret source of the risk reward, but we've got to be consistent with it and our trading edge and approach. Now, I am a massive advocate of people using a trade journal to help show you where you're best at trading, what day you're best at trading, what product, what strategy, what edge. It can show you so much detail to the point where I can know the exact time of the day on a market where I have a win percentage of 55% with a risk reward of 2-to-1. And that's invaluable information. So for those that are just starting out, or for those that are struggling a little bit and want want a bit of direction, pick a trading style. There's no need to reinvent the wheel here, but put some trades through the demo account. Find out when you're more likely to have your winners, what strategy for you works best. Understand the difference between those winning trades and the losing trades. Is it the time of the day? Is it trading a certain market which you really struggle at? When I first started trading oil and gold, all I did was lose money. And I've worked with traders where they trade only the S&P 500, and statistically, they're really, really bad in the morning, but very good in the afternoon. Guess what they do now? They only trade the afternoon. Become a master of one trading style rather than a jack of all trades. And that goes for investing as well. Warren Buffett has one approach, sticks to it, rinse and repeat. We want our trading to become boring. We want to become a sniper in the market. We see our edge, we take it because it's backed up by the stats. If we lose on to the next one. And it's understanding that could be so beneficial. Record all of your trades, write them down in a journal or use a paid journal, whatever it might be, to see the stats. You can take so much from that when you review it. You think any field, any professional sport, they review their performance. That's how you get better. You work on it. You decide how you're going to implement a new strategy potentially to help combat it, whatever it might be. But review, record your trades, back your process, and let's be the casino. Hopefully you all found that useful. Hopefully for the newer traders and investors, or even those that have been sticking at it for a while, will find that useful. Feel free to, if you're watching on YouTube, any comments, let me know. Feel free to send me a message on Twitter if you want a certain video covered. And also, please do remember, like, share, subscribe, all of that. It does help us greatly. Thank you guys, and take care.